Okay, let me.
Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Amazon heading into earnings. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a speculative, more advanced trade than we usually talk about on the Stock Play of the Day. On Amazon, speculating on earnings, we looked at a long butterfly spread with calls. And we did this with a little bit more time than we normally do on an Amazon earnings. We went out to November. Our expiration was the 5th. We had 10 days remaining on that. And that's a good thing because after Amazon's earnings, the news wasn't good per se in Amazon. And Amazon is down since their earnings report. It's bouncing back a little bit. So let's see what's happened and talk a little bit about what we could do with our butterfly if we would like to try to adjust it at least. Okay, so what I have here, we in the Ally Invest chains, we have a 15-minute chart. So we always tape the Stock Play of the Day live at noon on Tuesday. And this green line, which is now red when I put my cursor over it, is where the stock was at. So this was noon. This was the rest of the day trading. And one of the things that's very interesting about this, now, we do the Stock Play of the Day on Tuesdays, and we are dealing with live markets. So the markets are moving. And we did talk about the fact that we probably would do this trade closer to their earnings event, which was on Thursday after the close. But if you did look at the trade, the stock actually had a really strong move going into earnings. So the underlying stock, when we did the trade, according to my screenshot that I'm looking at here, was right around 3,375. And it got up pretty close to 3,500. So at that point in time, you probably were up on that trade without it. Not probably. I'm pretty sure you were. I don't know exactly where the options would have been at that point in time. I didn't take a screenshot of it. And if that was the case, most of the time I would just close out that trade. I would close it out just because I don't want the risk that the earnings pose. Now, I also might have missed out by closing it out because trade might have went a little bit more in our favor. But overall, at one point in time, this trade was profitable on paper. And as always, these aren't meant to be recommendations. We're just trading them on paper, trying to learn here. But then we see the big drop down. Now, the stock has bounced back, and it's almost where it was when we initially put the trade on. We're trading right now at 33.44 on Amazon. So it bounced down, it went down. A lot of people saw that as a buying opportunity, and it looks like it has bounced back up a little bit overall. So with that said, what do we do with our trade? We looked at the long call butterfly, and here's where Amazon is right now. We see it down actually 100 points today, down about 3% overall on the trade. And if we scroll down, we see the trade that we were looking at was the November. Well, and I should highlight this before I get too far away. We got 7 more days remaining to expiration. So we have a chip in a chair, if you will, as far as our speculative trade is concerned. November 5th was that expiration date. So there's still something in it. When we put the trade on, we only paid 50 cents for it, which means for every 1 by 2 by 1 butterfly, for every butterfly that we put on, entered all as one trade, our total risk was $50 plus commission on that trade. Total upside on the trade was around $2,000. Well, it would actually be $2,000 minus the $50 overall that we actually put the trade on for. But we weren't looking to try to do that. As I mentioned on Tuesday Stock Play of the Day, while we were doing the call, we just said, if you double or triple. If you can put this on for 50 cents and you can sell it for $1.50 or $2, you want to get out. You just want it. That's the mentality that you need to have on the trade. And also, we limited our risk by doing the trade overall. The main reason why we're doing the butterfly is if we would have just bought the one option contract that was part of our butterfly, that option contract that we were looking to buy was around $14 overall, just to buy a way out of the money option contract. So we did the butterfly and we got the cost down to about 15 cents. All right. So with that said, here's the butterfly inside the Ally Invest option chains. So I'm on the call side of the chains. In order to set up a butterfly, all we do is we hit this little drop down right there, and we just put a buy in. I already have it all set up. So we have the 35.50 strike call is the one that we bought. We went 20 points up, and that's where that 2000 comes in. So a 20-point wide butterfly. We bought the 35.70, and then we went out and went 20 points up again and bought the 35.90. Now, when we did this entire trade, I'm going to show it in the workbench. It was trading for around 50 cents at the midpoint. That means that we would spend $50 plus commissions, and that would be our total risk on that trade. You can now get out of the trade for 15 cents. But at this point in time, you might want to just let it ride, see if it comes back into your wheelhouse. Now, there is a trade that you could look at, but it adds a lot of risk on the trade. And let me talk about the profit and loss calculator first. So here in this instance, here's where the underlying stock is at. If the market does come back within that range, we do still have a potential for some profit. We have 6 days remaining till that expiration date. And you see here that there's a chance. There's a chance that it could come back and land somewhere in between our strikes. And let me zoom out a little bit here. All right. So then if you see that, then what we have here is as expiration approaches, if we are correct on our forecast and it slowly starts going in that range, I'm going to regraph it. Now you start to see that profit and loss graph look a lot more like it does at expiration. At expiration, this is your maximum on the trade. So ideally, without any other risk, you could just leave the trade on, see where Amazon goes next week. One of the things that I will do with a butterfly, it's a little bit advanced overall, but if I was wrong on my forecast, one thing that you can do is you can turn it into a short call spread. And Amazon does have some premium left in it because it's just an expensive stock. 1 day's worth of time in Amazon is worth a lot overall, and we have 6 days remaining. So how could I adjust this trade? The concept would be, and I'm not saying, once again, not meant to be a recommendation because you're going to add a lot of risk onto the trade, but you can sell this option contract and you're still getting some premium for it. It's still trading for $6 and it's way out of the money and earnings have gone away. Implied volatilities have came in, but you could sell that one, buy an additional further out of the money option contract. And then you're basically rolling into a short spread. And you're hoping that the underlying stock then would stay below 35.70. All right, so how does that work? This one we'd be selling. And so I'm just going to remove it. And once we do that, we would then, in the same trade, buy an additional one here. So if we go down the profit and loss graph, now you see the additional risk. And let me zoom down a little bit. Actually, I'm going the wrong way on the profit and loss graph. Okay, so now you're bringing in a net credit to the account. You're going to do okay. It's basically saying, I don't want the cheese anymore. Just let me out of the trap. You have a long way before that underlying gets to that strike, but it could, right? So there's still a lot more risk. And now you have 2 short spreads on. And if I have 2 short spreads on, they're 20 points wide. That means I've opened up $4,000 worth of risk to try to make a small amount on this trade. But if we did that trade, here's the way it would look. We're going to sell the 50 by the 3.9 or so. Okay. So let me go in and see what the net credit would be. Okay. So working off of what we did the last time around. So we would be selling to close. Oh, there's that. I got to go down a little bit more. selling to close the 35.50, which was where our strike began, and buying to open the 90s. And let's do that. And this would be our adjustment to the trade. There's a few other things that you can do, but you paid you paid 50 cents for the trade. And I don't know who got it wrong. Either the market got it wrong or you got it wrong. But overall, Amazon after earnings was down quite a bit. It was down about $100 on the open, I think. And that really translates. The expected move was about 125. So and we talked about that a lot on Tuesday's stock play of the day. So it didn't move quite as much as expected, but it did have a very strong downturn on the open. And right now we could roll into this trade and bring in $1.45 net credit to the account. We paid 50 cents. That means that we could make a buck on this trade, but we have a lot of risk to do that. So you got to think twice about that type of scenario. And this might work a little bit better if we had a little bit lesser wide, like not quite as expensive of an underlying as Amazon is. And we didn't have the the width of the strikes quite as wide, because that's what creates that risk. The fact that it was 20-point wide, we're going to roll into two spreads, and that would be $2,000 per spread of risk that we're going to add on. So is it worth the risk to try to not lose on the trade and make about $1 when it's all said and done, or $100 on our 50-cent investment? That's for you to decide overall. And once again, always meant to be on paper. So I'm going to click the trade button here. Let's go back to the chains, and I'll just show you the trade button. The way it would work, just to let you know, is we're not selling to open this trade. We'd have that position on. So you'd have to adjust this and say sell to close. And then you would buy to open the other one. And that would end up being, in this instance, 2x2 short spread when you're all said and done. Well, actually, this is the trade. So this is one contract for one contract. So that's right overall. So net credit to the account of 150. Click on that. You're selling to close the most expensive option, buying to open a lower priced option contract. You're still hedged on the position, but you've added a bunch of risk, and you're trying to just basically get out of the trade and get your 50 cents back overall. All right. Well, that's it for this edition of the Stock Play of the Day Overtime. We will be back Tuesday for the next Stock Play of the Day. I want you to click subscribe and ring the bell, but I also want to highlight the fact that we are having a digital conference on November 3rd. It's going to be an all-day event, and you're going to have to type in the URL ally.com/digital conference, and that will take you to the registration page and tell you all about the event. Ally.com/digital conference. Check it out, and hopefully we will see you this coming up Tuesday on the next Stock Play of the Day. Thanks for coming, everyone.